with a sheep disguise. That's next on Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Vernon in Dubai. Now, the US jobless rate has climbed to a two-year high in February, even as hiring remained healthy, which points to a cooler but resilient labour market. The figures illustrate the type of softening in the job market that the Federal Reserve wants to see, but will it be enough for the central bank to start cutting rates? Let's try and get some analysis from Ryan Lemont, co-founder and CEO of Neovision Wealth Management. Maybe, Ryan, you could make sense of all this confusing data that we keep getting out of the US. But I want to start on US equities, if you don't mind, because we did see a bit of a downbeat mood at the end of last week. It seems like people are questioning whether this record after record breaking rally is coming to an end. Could the CPI print on tomorrow, I should say, actually be the catalyst that resurrects the mood?
Good morning. Thanks for having me again. I think it's no secret. I've been saying it for quite a few months here on this show that we're contrarians. We don't believe in this rally, in this tech rally, even though it's happening, but it's just senseless because it resembles very much what we saw in year 2000. I was much younger, but it's very much like it. And we believe it's most likely it will end in tears. And I'm happy to take this responsibility for saying this. So I think people are realizing it. The parallel with Cisco in year 2000 is very striking. Cisco was the only company producing routers when internet came to be in year 2000. And today it's NVIDIA with GPUs and chips. So will it be the same? We think yes. I think people are realizing it as well, especially the older people who have been here in year 2000.
Well, so then, Ryan, I mean, it's interesting that you point out that you're a contrarian and also that you were much younger back then when we saw something similar to this. So then back to Lizzie's question, I mean, what is actually going to stop this rally from happening? Because there's no signs that are pointing to what it is that you're saying.
Well, there are several things that can happen. The obvious ones is unemployment going up, commercial real estate, regional banks, and something related to NVIDIA itself and AI itself. I mean, Sam Altman got fired just a few months ago in a very surprise move, and then how he's back. So it's a very young industry that is still developing, and there are many accidents that can happen that can wake up people. And then there's geopolitics. We have rarely seen such positive correlation between geopolitical events across the world. US, Iran, North Korea, South Korea, China, Taiwan, Ukraine. So there's a lot of positive correlation in these geopolitical events that can also trigger a few things. That's why we prefer to stay in, let's say, not so much overvalued markets and stay away from overvalued markets.
OK, so you're in the camp that warns about the concentration risk. I'm interested that you mentioned about regional banking because it's a year to the day since Silicon Valley Bank's collapse. How much more of a crisis do you actually see in regional banking then?
Well, look at the New York Community Bank. I mean, just a few months ago, it was a $10 billion market cap bank. Today, it's officially a penny stock. So we think there's more to happen, and this will be triggered by the commercial real estate. So the CDOs of 2008 is today's commercial real estate. And we think the crisis is not yet over because it's quite big.
Ryan, let's pivot to China because, of course, we mentioned this is the last day of the NPC meeting. Our MLive poll survey talks about how investors still feel like they need more convincing in terms of being bullish on China. But I know you and your team are not necessarily sitting on the sidelines. I mean, is this still a market that you are continuing to be bullish on?
Yes, we took the sidelines, actually, until prices went to levels that were absolutely senseless. So it's the complete opposite of what we're seeing in the US, where prices are very, very high. In China, they went to levels where it's a no-brainer. It's a screaming buy. And that's why we started stepping in. And we're happy to take a few percentage points down until we think the Chinese government steps in with something more serious. And this is when we see a big snap-up of Chinese stocks. So, yeah, we're starting to put on positions on very specific Chinese stocks. Absolutely.
A screaming buy for China China. But then what's your outlook for oil demand with China as a kind of factor into that? Because you've had Aramco saying that oil demand is growing in China, but we were talking about this before, the CNPC saying that crude consumption growth is starting to slow.
On oil, we're looking at the supply side, because on the supply side, there will be a crunch eventually. Because if you look at capital expenditures happening on the supply side, whether upstream or downstream, 85% of this capex is replacement capex. But if you look at the total capex, it's actually 30% lower at what we have seen a few years back. So if demand ticks up just a little bit, there will be a supply crunch, and that's why we are still positive on oil. China, there will be an increase in demand if the Chinese government, or when the Chinese government steps in and supports the economy.
If and when, Ryan, that is the big question. Really appreciate you being on, though, and giving us your insights. Ryan Lamond, co-founder and CEO of NeoVision Wealth Management, joining